This is a Federal News Network podcast.
With the third quarter of 2023 wrapped up, TSP returns did not look quite as solid as they did last time. To get a sense of what that means and what investors should consider, Federal Drive host Tom Temin got an update from certified financial planner Art Stein.
And Arthur, what looked like a good market in the earlier part of the year seems to have slipped a little bit in the third quarter just concluded for the TSP returns.
Yeah, for the stock funds, Tom, it was, third quarter was bad. All three of the TSP stock funds declined 3 to 5%, which is, a lot for just a 3-month period. But over longer periods of time, of course, we still have very mixed performance. But year to date, the stock funds have been good. They're positive, have very good returns. If you want to look since January of 2022, then the stock funds are negative. But since January 2020, which to me is the COVID period, it was January starts out before COVID hit the United States and affected us financially, economically, and of course, personally. But the C fund's up 40% since then, the S fund 19%, the I fund 10%. So in that very tumultuous period, stocks have done well. Now, the problem has been the bond fund, the F fund. Not the G fund, which is short-term bonds, but the F fund, which is corporate and government bonds, is negative over all those periods. Like it's down 9% since January of 2020. And of course, that is probably the worst bond market performance maybe ever, to have bonds be negative. They're negative this year, then they've had negative returns 3 years in a row. I think that I'm correct in saying that is unprecedented. It never happened before.
But government bonds are one thing. Corporate bonds are something else entirely, in a sense.
But we're not talking, remember, about the G fund, which is all short-term government bonds. And really, Tom, it's more like a savings account, because even short-term government bonds normally in the private sector fluctuate in value, but the G fund does not. The F fund does. It's down because the Federal Reserve has been raising interest rates. But those bonds, even the corporate bonds, it doesn't mean they're not going to pay off. And it certainly doesn't mean that they're not paying interest, which they continue to do. And as the price of the bonds goes down, the dollar amount of the interest does not go down. So they become quite an attractive investment. So right now, the interest being paid by the bonds in the F fund is about 3% of the total value of the F fund. It's what we call a 3% yield. And it means that people who are buying the F fund now, are getting a very good return for something that has a potential to increase in value quite a bit if interest rates stabilize and especially if interest rates go down. So this is the kind of problem that all investors have, which is, stocks have historically the best return, but they're very volatile. They go up and down. And now bonds, which historically are much less volatile, which tend to not go down very much and certainly not for very long periods of time, all of a sudden, they're not doing as well. To me, that's a kind of time when you want to be investing in these investments.
Yeah, so to deal with the volatility, in some ways, it's the eternal lesson. You have to balance cash, bonds, and stocks, right? Nothing essentially
Absolutely.
New here.
So, since January of 2020, as I mentioned, the F fund, the intermediate term bond fund, is down 9%. Well, a lot of people will look towards the G fund, which is up 9% over the same period. And, that looks pretty good. But I would also point out that inflation over that same time period is up about 19%. So for people who invested in the G fund, they've lost a lot of purchasing power, even though the G fund is increasing in value. And that's not even taking into account taxes. So yeah, the G fund looks better than the F fund right now, but as a long-term investment, historically, when you factor in taxes and inflation, the purchasing power of the G fund has gone down quite a bit. And even the F fund has lost purchasing power. It's really only the stock funds, especially the C fund and even the S fund, that have done well enough to increase purchasing power over that period of time for investors who are willing to put up with the fluctuations in value.
We're speaking with certified financial planner Arthur Stein of Arthur Stein Financial. So then again, an eternal lesson is the sheer return raw number doesn't give you everything you need to know to decide whether for retirement you are doing the best for yourself financially. You have to take into account the tax rates, the yields,
the inflation rate, and what historically has been the best long-term investment. But then you need to think about how much money you need to spend in the short term and in the long term. I mean, for someone who's a retiree, if they're taking out $50,000 a year to live on to supplement, say, their FERS annuity, having money in the G fund that they don't have to worry about, say, $100,000, 2 years worth of expenses, I mean, that would certainly make sense because you don't want to have to worry about how you're going to get money out for those short-term needs. But for your long-term needs, someone retires at 65, they could easily live 30 years in retirement. So they also need to think about, well, where am I going to get the money 10 years from now and 20 years from now and 30 years from now that I need to supplement my FERS annuity and Social Security, of course. If that money's been invested in the G fund, the purchasing power would have declined dramatically. If it was invested in stocks, based upon historical performance, they have a very good chance of having seen an increase in purchasing power.
Right. So then your overall advice for people that are worried about all of this volatility and, interest rates, we don't know what's going to happen. There are issues in the world, too, that could be affecting stocks and bonds and, investor confidence and so forth. What should people be doing now?
Well, I think, if you're working, you should be continuing to invest. And if you're worried about, say, the bond markets being down or the future of the economy, maybe continue to work a few more years than you planned on. I mean, people don't mention it, but one of the great advantages of working for the government is there's no forced retirement for most positions. There is, I realize, for some positions, but not for most positions. But you also need to think about what is a good long-term investment. And, I see people who panic and they pull all their money out of the stock funds and stick it all into the G fund and then just leave it there forever, and then do another mistake, which is that their biweekly investments all go into the G fund too. Well, don't do that. You can be much more aggressive with your biweekly investments than your current allocation. And if you are investing like that biweekly and the markets go down, that's a good thing for you because you're buying. And of course, you're just putting in a much smaller amount of money every 2 weeks. So, if that declines, I mean, you're just much better off. But being too conservative, having too high a percentage of your investments in either or both of the bond funds really makes it much harder to generate the amount of assets that many of us are going to need for retirement.
Certified financial planner Art Stein. We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts.